We now move on to inflation and deflation. Any revenue forecast or cost forecast needs to take into account possible inflation or deflation, and more often than not it is inflation. So the real question for you as an analyst is, when there is inflation in the economy, if the input costs are going up, then what will the company do? Will the company also be able to increase prices based on inflation or not? So that point is made over here. Some companies which are strong, either a strong brand, for example, or with proprietary technology, are better able to handle inflation relative to some other companies. So in section 4, there are two subsections. One deals with sales projections and the other deals with cost projections. Let's start with sales projections, and within sales projections, we'll look at both an industry level and then a company level. So you have a given industry, and let's say that due to inflation, the cost of input, so in this industry, the input or the goods that feed into the industry, the prices go up. What will happen to the price of the output, whatever this industry is producing? Obviously that price will go up, but how long it takes for those prices to go up or for this to transmit depends on the structure of the industry. What do I mean by that? If you have an industry where the companies in this industry are strong relative to the customer, in other words, the customer base is very fragmented, for example, the customer base does not have bargaining or negotiating power, then what can companies in the industry do? Then they can pass on the cost more easily. On the other hand, if your customer is Walmart, so you are based in the United States and your major customer is Walmart, it is very hard to pass on a price increase to a customer like Walmart that is huge and has a tremendous amount of power, buying power, right? So there, if the customer power is strong, then the industry might not be able to pass on cost as easily. The other point then is, let's say that we now have higher prices over here. Then in any industry, there will be a supply demand for that industry. If the prices are higher in the industry, then the volumes will come down. And the amount by which the volume sold in that industry comes down depends on the availability of substitutes. It depends on how competitors within the industry behave and so on. So if you take the scenario of a particular company, obviously the sales volume of the company will depend on how the other players react. Let's now come specifically to company related sales. What each company should do, or you as an analyst need to do, is identify the main costs. So what you're doing now is you've done the industry level analysis, and now you are saying what is the potential impact of inflation on a particular company. So clearly you need to understand what are the inputs, because when there is inflation, that doesn't mean that all inputs go up the same way. So you need to understand how those input prices are increasing. And you also need to understand the company's strategy. Now, some companies might try to pass on these the higher costs to the customer. Other companies might try to keep their final price low in order to gain more market share. That obviously will depend based on the company strategy and how the company chooses to respond to higher input prices. Ultimately, the revenue projections that you make for this company depend both on price and volume. And if you recall from your basic economics, the relationship between price and volume is given by the price elasticity of demand. So you as an analyst need to understand the price elasticity of demand of the product sold by the company that you are analyzing. Another point is related to a company which might export goods. So this company, for example, is a US-based company. It exports goods to Mexico. What is the impact of inflation in Mexico? If there is inflation in Mexico, then in Mexican peso terms, will revenue be up? If there is high inflation, then in Mexican peso terms, the revenue will be up. But what's the flip side? The flip side is if there's high inflation in Mexican peso, then as you might recall from FRA, if this currency, actually as you might recall from both FRA and economics, if there is high inflation over here, then what is going to happen to the currency exchange rate? The Mexican peso will probably depreciate relative to the US dollar. So net, there might not be any benefit. Again, we don't need to get into too much detail there, just recognize the main points. And then you can read example 10, which talks about passing input costs or not passing on the higher input costs. Coming now to the cost projections. So again, we look at the industry level and then the company level. At the industry level, you need to understand the purchasing characteristics of an industry, and this is important. In a given industry, you might have a convention that in this particular industry, the contracts are long-term. So if you have a particular industry where the contracts are long-term, for example, in the airline industry, there might be long-term contracts where they lock in a certain price, or there might be other industries where the contracts are long-term. If the contracts with suppliers are long-term, then what is the impact of higher prices of inputs? There will be an impact, but it will take a longer time for that impact to hit the industry. So you need to understand that. Some companies might be using hedging instruments over here. You need to understand that. Monitor any underlying drivers. So you as an analyst ideally need to be able to do a good job of forecasting price increases. So understand what are the drivers behind these potential increases. What is the impact of inflation or deflation on the industry's cost structure? Or actually, the impact of inflation on an industry's cost structure depends on the competitive environment also. Then we move on to the company-related cost structure. So break down costs by category and geography. So you're just making this as granular as possible. For each cost element, determine the impact of inflation and deflation. So that is fairly straightforward. Another point that I'll make here in general is that if you have a company and if this company is dealing with several suppliers, then is it more likely to be hit by higher input prices or less likely to be adversely impacted? Less likely. When a company has many possible suppliers and two suppliers increase prices, then it might look for a third supplier, or the company might also be able to play the suppliers off each other and still try to negotiate lower prices. So when we talk about the competitive environment, the competitive forces, that has an impact over here. Simplistically put, if supplier power is weak, then the company is less likely to be hit by higher input prices. Do example 11 from the curriculum, just read through that. Okay, now we come to something very interesting and very contemporary, technological developments. Clearly, technological developments can change the economics of entire industries and obviously the companies within those industries. And something that has happened in front of all of us over the last 3 years has been this explosive growth of the tablet market, spearheaded by Apple's iPad products. If you recall, the iPad was launched in early 2010, and then just like Apple's iPad, you then have various Google Android based tablets and so on. Now, if you are an analyst and you study the PC industry, and within the PC industry, let's say you are focused on Microsoft, which has been a big beneficiary of the PC industry, because everybody who buys a PC then also has to buy Microsoft's Windows operating system. So is the introduction or the growth of this new market, the tablet market, is this going to have an impact on the PC market and specifically on Microsoft? Clearly, yes, because the one thing about the tablet is that it does not run Windows, right? If it's the Apple, then it runs Apple's operating system, otherwise it runs Android. So clearly this is a big threat to Microsoft. So now how do you deal with this sort of a situation? Do you think it is important for you to try to forecast Microsoft's revenues, costs, net income in the context of this technological development? Obviously, yes, because it is going to change sales, Microsoft sales. Will it also impact Microsoft's costs? The answer is yes, and we'll see how. The first thing that you need to learn is how to forecast sales, given that we now have tablets in the market. And here is what you need to do. When a new technological development results in a new product that threatens to cannibalize demand for an existing product, in our example, the existing product would be Windows related sales. So what we do is a unit forecast for the new product. In this case, the new product is the tablet, combined with an expected cannibalization factor. And we use this to estimate the impact on future demand for the existing product. So let me work through some very basic numbers, and then the rest of the example you can see. So this is Microsoft related numbers, and I'm just saying Microsoft and PC interchangeably, assumption being that for every PC we have, a Windows related sale. So if we take FY 2011, you have consumer PC shipments and non-consumer. So what have we done to personal computer shipments? First thing is we've broken it into two segments. And why have we done this? Because the tablet PC will have a different appeal or different penetration in these two markets. So it makes sense, rather than take the full PC market, to actually break it into components. Then the next thing to do is to figure out how many new tablet shipments there'll be. Obviously, we need to estimate that. So if we say there are this many tablet shipments, of which, notice that tablets 36785 in the consumer market. So effectively 96% of the tablets will be hitting the consumer market, not the non-consumer market, which makes sense. So clearly, if there is a cannibalization of Microsoft sales because of tablets, it is going to happen much more so in the consumer market. Then something that is hard to do in practice but easy to do in the exam world because it's given to you is the cannibalization factor. Do you think the cannibalization factor will be higher in the consumer market or in the non-consumer market? It's higher in the consumer market, and you'll be given that. So this particular scenario tells you that in the consumer market, the cannibalization factor is 30%, whereas in the non-consumer, the cannibalization factor is 10%. So that is the cannibalization factor for 2011. Now, what I want you to do is tell me what is the impact on PC shipments in 2011. These numbers are pre-cannibalization. And then this case is telling you, okay, these are the pre-cannibalization numbers for PC shipments. And then we are told how many new tablets there will be. And then we are told a cannibalization factor. So based on this, can you calculate the post-cannibalization PC shipments? So here is what you do. If you just take the consumer market, we are told that in the consumer market, the cannibalization factor is 30%. So we take 30% of the tablet shipment. So 30% of 36. And that number is 11,036. So if you actually do this, 30% of 36,785, what you should get is approximately 11,036, rounded up to 11,036. So this amount is going to be cannibalized from here. That means that when we forecast post-cannibalization, the number will be this minus 11,036. Now you can use the same logic for the non-consumer market where the cannibalization is only 10%, and then you can move on. But clearly this is step one. So I'm going to skip the details because I think that was the most important point. When you are talking about a new technological innovation such as a tablet and the impact on an existing market such as the PC market or the Windows market, from a testability perspective, what do you need to do? You need to be able to figure out the impact on demand, on selling prices, on costs and margins. If your target company, the company you are evaluating is Microsoft, then ultimately you are also concerned with the bottom line and the cash flow and so on. So we've already talked about how to model the impact on demand. We've said, okay, we look at the different segments and we look at the cannibalization factor per segment. So that helps you determine the post-cannibalization volume. What about the post-cannibalization selling prices? That is tough. There it depends on the company strategy. You might say that Microsoft will not change its pricing because of these tablets, in which case you just keep the same price, or you might say that Microsoft might reduce prices. That is based on your judgment and your knowledge of the company. But then the testable part after that is, how do you come up with operating costs and margins? Do they change? And the answer is yes, they change, because if you think about a company like Microsoft, obviously, as with any other company, it has a fixed cost component and a variable cost component. If sales are coming down, then clearly the variable cost will come down. So what you need to really do is understand what part of the cost is fixed and what part is variable. That is critical. And the curriculum goes through some detail explaining that there are two ways of doing this. There are many ways, but the curriculum talks about two. One is to evaluate the sensitivity of cost to changes in revenue. So over the last few years, you see that when revenue changes, by how much does the cost change? And I'll show you the details. And the other is to assign an estimate of the percentage of fixed and variable cost to the various components of operating expenses. So here is method one. Evaluate sensitivity of costs to changes in revenue. The basic principle is this. If you say that revenue changes by 1%, and for a 1% change in revenue, if your revenue changes by 1% and your total operating costs change by 0.3%, that means that 30% of your cost structure is variable. And let me show you how this working is done. This is the formula. Percentage change in variable cost is percentage change in, you can think of this as your total operating cost. You see this term cost of revenue. This is very roughly analogous to cost of goods sold, but there is a distinction, and that distinction I have cut pasted over here from wikiinvest.com, so you can read this. For services companies, we generally don't say COGS, because what does COGS mean for Microsoft? So in that case, we say cost of revenue. But overall, this is the percentage change in the overall operating expense divided by percentage change in revenue. So if we look at numbers for the Windows and Windows Live segment, over this time period, there was a 17% change in total revenue, and there was only a 5% change in operating expense. So if we use this formula, what do we have? We have the numerator is 5% divided by 17%. So 5% over 17% gives us essentially the ratio over here is 29% or 0.29. So what this tells us is that the variable cost is 29% and the fixed cost is 71%. So that is an important calculation. What about method two? Here again, don't need to get hung up with the details, but the idea is to assign an estimate of the percentage of fixed and variable cost to the various components. So if we look at the cost of revenue, there we say that the fixed component is 11%. With R&D, the fixed component is 22%. With sales and marketing, the fixed component is 27%. And with general and admin, fixed component is 10%. So when you add all these numbers, 11, 22, 27, and 10, you will get 70%. So using this method, you have fixed is 70% and variable is 30%. Does it surprise you that for a company like Microsoft, a pretty substantial part of the cost is fixed? It should not, because in the software business, obviously the variable component is going to be relatively low. So what do we do next? Given this 70-30 split, we make several assumptions, and I don't think this is overly testable because the assumptions will depend on the specific industry and the specific company. So I'm just illustrating this. Based on assumptions, we say, we've already predicted revenue numbers by saying that, okay, there is a certain degree of cannibalization that will happen, but pre-cannibalization, there'll be a certain revenue number. There are certain assumptions, and we come up with EPS projections. That's shown in the curriculum. Then we make certain post-cannibalization assumptions using the 70-30 also, and come up with post-cannibalization EPS. So just recognize that this can be done. It is tedious, but not too complicated. Once you've done this activity, do you think you need to do any sensitivity analysis, scenario analysis? Obviously, because you have assumed a certain cannibalization factor. What if the cannibalization factor is not 30%? What if it is 40%? Or what if it is 15%? So clearly, to do a good analysis, you need to take different cannibalization factors. Maybe you make different assumptions and come up with the impact. So I'm not going to do this. This is done in example 13, but I'm just illustrating the fact that you want to do some sort of a sensitivity or scenario analysis. Coming now to section 6, which is long-term forecasting. So we are changing gears a little bit here. When you forecast, so you are forecasting sales numbers, cost numbers, net income, cash flows, balance sheet numbers, what is the appropriate time horizon to use? And what are the factors that go into deciding on a particular time horizon? The curriculum points out that here are some of the major factors. The investment strategy for which the stock is being considered. So if you work as an equity analyst and in your organization, the objective is to have stocks for 3 to 5 years in your fund. So that in a sense defines this is one of the factors that helps define the time horizon. The cyclicality of the industry. So if you buy stocks in the auto industry is fairly cyclic. So you will have a point of view that you want to hold your stocks until a certain point in the cycle, some mid-cycle point where you believe the valuation is optimal. Company-specific factors. So if a company is going through a reorganization or a company is going through mergers and acquisition activity, that might impact your timing. Or the employer might just have a defined amount of period, and you as an analyst need to follow that. Here is a point related to normalized earnings, which is touched upon briefly here, but something that you see in more detail in other parts of the curriculum. But having a longer term time horizon actually helps, because most industries and most companies have earnings which are cyclic. When the economy is doing well, then earnings tend to be high. When the economy is not doing so well, then earnings tend to be low. So when you are doing long-term forecasts, it makes sense to have some sort of a normalized earnings, which would be the earnings when the economy is neither overheated and also not in some sort of a slowdown mode, right? So that mid-level earnings are referred to as normalized earnings. So how do you do this? If you want to look at revenue numbers, then the curriculum emphasizes this trend formula in Excel, which is effectively a linear time series regression. So you can use that trend formula. The curriculum has evolved where they are making very practical suggestions about using appropriate functions in Excel, which is what analysts in the real world do. Also, with your revenue related projections and forecasts, you can use growth relative to GDP growth, which we've talked about, or market growth and market share, and we have talked about this before. Now here are some testable scenarios. I'm going to illustrate an important point. This is something that you see in other parts of equity. Very often what we do in valuation is to have a certain time period where we project free cash flows or project dividends depending on which model we are using, and then we come up with some terminal value. And very often that terminal value is based on some sort of a multiple. All right, so let's say that for the terminal value we use a PE multiple. Now the question here is this: if in a given company, in a given industry, the historical PE ratio or the typical PE ratio is 10, then should we just use 10 over here for the terminal value? So we forecast the earnings over here for the last period and then use the historical number of 10. Is that appropriate or not? The answer is it depends. If you believe that the future will look like the past, then you use the historical number. But if the future looks different, then you either add a premium or a discount based on your view. So what I want you to do now is read this, and then there are a few different scenarios where we will talk about whether to take the historical ratio, historical multiple, or whether to add a premium or a discount. So go through this. So what do we do in this scenario? The company is likely to earn higher returns on invested capital in the future. So do you add a premium or a discount to the historical? So here you will add a premium. The earnings growth is likely to accelerate in the future. Here again it would make sense to add a premium. The intensity of competition is likely to increase. So the competition is increasing. So this will put downward pressure on prices. So here you would put a discount relative to the historical ratio. The company makes a major acquisition or divestiture. This is uncertain. So you as an analyst need to figure out whether this is going to help or not. If you are uncertain, then you might just keep with the historical number. Now I want you to try this example 15, and then there are several questions over here. So if you have this company, so Air France, KLM, operates in the highly cyclical airline industry. These are the operating margins over the last 9 years. All right, for your forecasting, which is the most appropriate operating margin to use for your longer term forecasts? Or if you are forecasting into perpetuity, what number should you use? So here what you need to do is take the average of these numbers, and that average is 2.2%. Here are some more interesting questions, and note that, as I keep saying, with this reading, a lot of what you get is based on prior knowledge and common sense. So for each of the companies, indicate which choice is least likely to cause an inflection point. What does an inflection point mean? It means a sort of a discontinuity, that, you know, revenue is nicely going up and then suddenly either it goes up sharply more, or, you know, there is some sort of a kink in the train. So everybody knows Nokia. Everybody knows that over the last decade how well they have done, but over the last few years there has been a change. So which of these least likely to cause an inflection point? Pricing of technology components falling steadily, consistent with past trend. This does not look like least likely to cause an inflection point. Because of least likely, looks like a least likely, but let's look at the others. Consumers have been rapidly adopting smartphones, threatening Nokia's historic strength. So this actually causes an inflection point like this, and many of us have seen this happen. And the good thing about this reading is it's very contemporary, so we can relate to the examples. Nokia has formed a partnership with Microsoft to supply phones with a potentially important new operating system. So this might actually cause a uptick. So both these could possibly create inflection points. Least likely would be A. Now try number 3. So it has become more difficult for medical device manufacturers to receive regulatory approval. This might have a serious negative effect. A competitor has demonstrated favorable efficacy on a drug candidate that will compete. This might also create problems. Management speaking generally doesn't have any inflection points. So least likely answer again is C. What about this scenario? So you have an airline operator in Mexico. Here the least likely scenario is A. And what about 5? Again, very contemporary. LinkedIn, Facebook. So LinkedIn has low investment needs and low debt. So the best answer is C. All right, we now come to the last section in this reading, which is a grand finale section. Nothing new here, but what we do in this reading is take a particular company which sells wines and spirits, and we are going to build a model for this company. And actually, it's not we, the curriculum does it for us. And I'm just going to give you a high-level view and have you go through those models, because again, there is nothing new, but it is a wonderful case study. All right, so when you build a model, the first thing you do is understand the industry, and I'm not going to go over this industry with you. Then you understand what the company is doing within the industry. Then what the curriculum does is comes up with the pro forma income statement. So for the pro forma income statement, you do a revenue forecast. Here you can do bottom up, top down, hybrid. So given the data available, you use the appropriate set of methods. Are you constrained to any one method? No. So you can use multiple methods. Estimate your COGS and SG&A. These are your operating costs, the non-operating financing costs, other non-operating costs, taxes, and essentially you then have your projected pro forma net income numbers. Then you can forecast your cash flow and balance sheet. You estimate the capital investments, estimate depreciation numbers, estimate changes in working capital. Once you've done that, you can get your cash flow statement and your balance sheet. And then you can come up with the various valuation related inputs such as the free cash flow numbers, the EPS numbers, EBITDA numbers, and so on. So I have really compressed this, but the curriculum goes on over several pages. That brings us to the end of this reading, just a summary of the main points. Make sure you understand your top-down and bottom-up approaches. Simplistically, top-down starts with the economy and an industry, then company. Bottom-up starts from company-specific characteristics. Note that these methods apply both to revenue-related estimates as well as cost-related estimates. And generally, they are used together. So they are combined to create a hybrid approach. Within top-down, there are two major subcategories: growth relative to GDP growth, where you forecast GDP growth, and then you say, okay, this company or this industry, how is it going to grow relative to GDP? The other is to forecast a given market or industry, how that will grow, and forecast how the market share of a particular company will change within that industry. Then we talked about operating margins and economies of scale. So here I'm actually focusing on learning objective-based points. The key point here is that if you have a scenario where there is a positive correlation, so the correlation is positive between sales and operating margins, that means we have economies of scale going on. Forecasting COGS, SG&A, COGS generally is directly linked with sales. So when sales is up, COGS is up. SG&A is also linked, but less so. Financing costs depend on the level of debt and the rate that is being paid. And income taxes, the key point here was that we need to be careful about the effective tax rate, which might be different from the statutory tax rate. Then we talked about balance sheet items. The key point here was that with balance sheet items such as accounts receivable, working capital, what we do is start with the appropriate income statement number and then take estimates of ratios such as DSO or inventory turnover, and then come up with the balance sheet numbers. Competitive advantage and ROIC. Main point here is that if you find a company with a persistently high return on invested capital, that is an indication that this company probably has a competitive advantage. You must know Porter's 5 forces. That is the CFA Institute's favorite industry analysis framework. So very high probability that you'll be tested on this. You need to understand the impact of inflation and deflation. Key point to recognize is that whether a company can pass on higher costs depends on the competitors, the forces. If a company is strong in terms of being able to dictate terms to suppliers and customers, then it can pass on prices very easily. You need to understand the impact of technological development. Here, the critical thing to understand is that when a new technology comes in, you need to have an estimate of the cannibalization factor. So the cannibalization factor, and also recognize that there are different segments. For example, we talked about the PC industry, where we divided broadly into the consumer and the non-consumer, and the cannibalization factor will be different depending on which sector you are talking about. Deciding on an appropriate forecasting horizon. So we had 4 points there that you need to know. And then putting it all together was the model at the end, which simply is doing all that we have talked about in this reading. So that is it. Go over the learning objectives. The summary is good. It is also based on the learning objectives. These two are connected. Examples are immense. So some of them are better than others, depending on how much time you have. Go through them. Unfortunately, there is just one case study. So for a 100-page reading, most of the emphasis is in the examples, but there is just one case study with 6 questions. So you might want to practice from other sources. But my concluding remark on this is that you spend time on this based on how much time you have. There is a good chance that based on what you've learned from other places, you will have the necessary knowledge to do well on a question related to this particular reading. That is it.